Well, welcome to today's masterclass with Pink Pig. Today we are joined by the fabulous Ciaran Burke, who is one of the founders of Swoop. Swoop are a funding company, and they help match, and I hope I'm saying this in the right way here, Ciaran, as they help match the right funding solution to our clients, you as business owners. So I thought we'd invite Ciaran on today just to chat through some of the scenarios that we regularly see with our clients, and just to chat in general about funding a little bit more. Yeah, do you want to do a little introduction, Ciaran? Because you can obviously introduce me.
I don't know. I think you did a great job, Cheryl. Because essentially, it's about finding the right funding, because every small business is different. They have different numbers. They're in different sectors. They're in different stages of growth. And the reason we exist is to take the time to understand their financial position and their numbers, and from that, give them a whole of market solution, because it's important not to just think about one product, but all the different products that are out there. And what we try and do then is find the right one for you at that given time. So that can be anything in lending, it could be an investment, or it could be in grants.
Perfect, yes. And we've been working together now for nearly a year at the time of recording. And yeah, you've been able to help quite a few of our clients, so yeah, massive thank you as well too. And we also, just for anyone who is watching this and thinking about funding, it is a really smooth and easy process, and we do walk you through it as well. So just wanted to point that out as well. It's not something we just leave you to it kind of thing. We do walk you through it all. So I think the first thing I wanted to go through was maybe some options, what we see from our clients of scenarios, and therefore what funding would be best for them. So the first one we see is startups. So obviously people have got ideas of a business, they need some money to get going, or they need to buy some equipment and things like that. So in that kind of scenario, obviously I know that's a very general one, but what kind of funding would be right potentially for those?
So obviously, when you're a brand new startup, often you can see a lot of barriers straight away, because banks or lenders are coming at you going, you've no trading history, or it's just an idea on a page. So what you need to do in terms of funding is start to articulate what it is that you need capital for, and how much capital do you need. And then what we can start to do is understand the different options available to you. One thing that is always available to all UK businesses that are startups within their first 3 year of trading is the startup loan scheme. So it's a government-backed loan scheme that's really advantageous for UK founders. And so what allows you to do is you can get access to up to £25,000 per director in the business. That can be spread over a 5-year period. It's done at a flat rate of 6%. So if you think where the base rate is at the moment, that's incredibly good value. And the fact that you can spread it over that long period of time means that those monthly payments should be very manageable. The other side to it as well is you get a 6-month interest-free period where you don't have to pay anything during that period. Also, to say, the way you can then go for that startup loan is you don't need to go for the full 25,000 at once. You might go for 10,000, put that to work, come back a year later, and then get another additional 15,000. So it's very flexible like that. And also, if you have another director or a co-founder, each of you are entitled to go through it. And how the process works, it's a bit like going for investment. So they want to understand your business idea, the concept, and ultimately what is the forecast for the business, particularly in those kind of first 2 years. So that they're the kind of things that you want to be thinking about and being able to articulate. So it's kind of an application built around your business idea. It usually takes around 4 weeks from putting all the application together to getting the answer to getting the cash in the bank. The one thing that I would flag is, if you have a poor credit score, a poor personal credit score, not a business credit score, that's where we will see the majority of the rejections, as opposed to down to the business idea. If you have a good, healthy personal business score, usually that is what will drive the acceptance in that particular area. The other kind of considerations, if you're a brand new business, are, again, what are some of maybe the capital requirements? What are you going to be spending this money on? And if anything is a physical asset or a heavy asset, so it could be a piece of machinery, say you're setting up a printing shop and you need a digital printer, and anything where there's like heavy goods and services, lots of asset finance providers are willing to give you the cash for those big purchases, because essentially what they're doing is they're valuing that asset. Say, yes, I entrust you to do this. I'm not necessarily banking on you turning this into a gigantic business overnight, because ultimately, if it doesn't work out, I can take the asset back and sell it because it's got good resale value. So if you ever have capital machinery purchases, it's always a good one to think in mind. You don't necessarily always have to pay it out of your own pocket. And also, if you think about it from a tax perspective, you'll also be able to write up to £1 million in capital expenditure each year. So again, when you're thinking from a corporate tax perspective, it's also a useful one to have in mind. But what you'll see is there kind of a lot of the main kind of go-to pots when you're starting out, because if you think about classic lending, I want a loan from a bank or a term loan, a lot of it's predicated on actually getting in and getting trading. You'd be able to get access to kind of credit cards or overdraft style products, but usually they kind of range from maybe £5,000 to £20,000. So again, it depends on what your capital requirements are. But usually we would always advise anyone in that startup phase to always look at that startup loan scheme. Is a great way to kind of kick off capital into the business. And then, I'll stop talking now, Cheryl. But the other one is, you might not necessarily want to go down the lending path. There's grants available. So if your business is anything to do with innovation or doing things differently, now you actually have to take yourself seriously when you ask that question, because often everyone's got great ideas and they think it's the most innovative thing, but you genuinely, if you're doing something that hasn't been done or you're pushing the boundaries of technology, there are lots of grants available. Innovate UK usually run once a quarter, called the Smart Grant competition, where there's usually up to 20 million available, and an individual can go up to 250,000. If you're genuinely doing something innovation, you absolutely should put your hat in the ring for that. And then the final one I was going to say is, if you were looking for private investment, in the UK, you have a fantastic scheme called the Seed Enterprise Investment Scheme, SEIS. So if you're looking for equity investment, you can raise up to £250,000 under SEIS. And as an investor giving you money, I can get 50% back from HMRC straight away. So if I give you £10,000, they give me £5,000. And if the business was to ever go under, I can get a further 25% back. So ultimately, I'm risking 25% of my business. Now, again, the caveat there is, you might be setting up a business that is going to be a steady, stable business. It's going to give you a nice lifestyle, whatever that might be. Most investors, if they're looking to make an investment, they want a high growth business that's going to be trying to reach a market capital of £1 billion. So if you can't quite articulate that, then maybe that's not the right path to go down.
Yeah. Lots of options there then. And I think a lot of people would be wary at that initial stage, especially if they haven't quite proven their idea yet. But it's good to know that there is more than one option out there for them. That's really cool. So you touched on there the asset finance as well. So one thing we get asked by our clients is, when they buy equipment or vehicles, initially their initial instincts will be to get the finance with whoever's selling them those things. Especially with cars and with vehicles, that's always been the case, isn't it? You always just get it from the dealer. But yeah, are there other options available? What would they be?
Yeah, absolutely. I think with anything SME finance related, you should always shop around, because it's so different to the consumer. In consumer, it's pretty black and white, and you know what you're going to get because they actually have to create these products for so many people. But in business, so many things are bespoke to that business and that offering, that there's always a deal to be done. Like even if you think about business energy, it's kind of mad, but every single business that has an energy contract has a personal contract specific to them with their own personalized rate. But the same can be said about financing. So if you are thinking of, we see a lot of people buying vans, particularly in that kind of transport space, supporting that Amazon ecosystem, and naturally they might go to a specific garage and they might have a relationship with one provider. But what's the harm in looking at the options? So, and there's multiple options within the category. You might want cash to buy the asset in its own right. You might want to put a plan in place where you're leasing the asset, where you give it back at a certain period of time, or you've got the option to buy it at the end of that period. The real attraction with asset finance is typically because it's secured against that asset, or you're willing to give a personal guarantee against the asset, the rates are substantially lower than if you were going for a standard kind of working capital loan, which is really, really important, I suppose, in particularly in today's time period where we have a really, really high base rate relative to the last 10 years or so. So if you're looking at the asset finance category, one, if you are going into that category, you can get a better rate than say unsecured finance. And we kind of touched on it a little bit as well, as also you have £1 million capital allowance to spend that you can write off again if you've got a large corporate tax bill that that's coming up. It's also worth thinking about, particularly where corporate tax has now moved from 19% to 25% for those businesses that have a profit greater than say 50,000. So if you're about to hit 75,000 profit, then get the 25,000 pound van on finance and get yourself back to the 19% corporate tax ban. So it's multifaceted. But in terms of what you were alluding to, Cheryl, absolutely, if I'm going to make that purchase, it's in my interest to think about lots of different options, because there's so many different asset finance providers out there with different offerings. But it's a great category in terms of pricing relative to other lending products.
Yeah, that's cool. And if you can do refinancing of assets as well, can't you? So if, for example, somebody's got a vehicle existing finance and their balloon payment, for example, is coming up, there's options to refinance that balloon payment as well, isn't there?
Yeah, absolutely. Yeah, it's a really, really good point here, Jim. You do a better job than I do.
It's only because we've had a scenario like that I'm aware of it.
Yeah, absolutely. But I think also just in general, people sometimes think when they get their facility, that's it, them done. Me in the 5 years, we'll see you then. There's nothing I can do at it. But actually, whether it's asset finance or term lending, as your business starts to evolve and change, and it usually the trigger points are you have to have done like a full year and done a full set of filed accounts, or maybe 2 sets of filed accounts. But after which you've now got a whole new, because we're SMEs, we are changing all the time. Like it's never like this. So if you should take advantage, particularly if the landscape has been positive over the last 12 or 18 months, you can absolutely use that to your advantage to go back to either the existing asset finance provider to look to refinance if as you said, there's the big balloon payment coming, and from a cash flow perspective, that's not going to be bueno, and you want to rethink that cash flow scenario. But equally, there are going to be other asset finance providers out there that might see you as attractive now, because your scenario's changed and you weren't quite on their radar the last time around. But equally, if things haven't gone so hot as well, lenders, they're thinking about themselves and how they can have long-standing relationships as well, which is why there's refinance, there's cash scenarios are in place, because they want that long-standing relationship with you so that you can use these facilities to make your capital purchases and have that long-standing relationship. So it's always good to have the conversations and keep an active dialogue, as opposed to always assuming it needs to be the way it is.
Yeah, no, that's cool. And the last scenario that we see a lot of is the working capital solution. So it could be that somebody's got a big project that they want to fund because they're not going to get payment until the end, which I think they need to sort the payment terms out on, but that's another story. Or it could be they're looking to grow, so they need some money to pay for employees or premises before they've got the additional money coming in and things like that. So in that kind of situation, where would you usually look to point them?
Yeah, so I mean, you've a plethora of different options here. So again, you're starting off with like, how much cash do you need? What is your kind of cash cycle in terms of, like, it's always really, really important to understand how much do you need to spend each month, like what goes out each month, because ultimately whatever or what comes in each month and what has to be spent each month, because whatever we get in place has to fit underneath what comes in each month. But in terms of the working capital side of things, you're thinking about all the different elements in the business about which you're going to raise or access cash again. So the example you're like there, where contract in place, not getting paid for a long time, so you could do buy now, pay later, whereby you can put the invoice against that future contract, and you can get that in installments. Or you could look at like a selective invoice finance facility, whereby the invoice is from a blue chip or a reputable customer, so they'll buy that invoice for you, where they'll give you maybe 90% of the value of that invoice now, and then they'll collect 100% of that invoice at the end of the day. Or it could be just general kind of working capital scenarios. So what providers in this space will start to do is they'll look at things like, where are you getting your cash from? Is it a credit card terminal? Is it a Shopify link? Okay, let's have a look at them. What's your average monthly recurring revenue from the Shopify link or the sum up credit card terminal? They'll look at the data and they'll say, okay, based on how much you're averaging a month, I'll advance you two months or 3 months or 1.5 months, and you can get that cash instantly, and then you pay that back over agreed period of time, and they take it out as a percentage of your sales from the Shopify link or from the credit card terminal. So, or they might just look at your accounts, and they'll look at the cash flow and see how much EBITDA is coming through the business, and they'll give you a percentage of the EBITDA as a facility type. You can also look at all the whole of the invoice finance book. So we talked about, say, one particular invoice, but what other providers can do is look at all of your suppliers and offer you a facility against all of those suppliers in one place. But like, ultimately it kind of comes down to your business, understanding the ins and the outs, and then what are the assets, not the physical assets, that we could use to raise capital again. So it could be invoices, it could be recurring revenue, it could be cash that's already in there, or it could be stuff on the balance sheet. So there could be assets on the balance sheet, property, that sort of side of things. So it's looking at all the different things that are available to you. People often do research and tax credits every single year, and you can get an advance sum of money against the R&D claim. So you can get the cash up front. You might have HMRC might owe you payment back. You can get cash against that. You might have a particularly large VAT bill. Instead of paying that, you could get a provider to pay the bill, and then you pay them back in installments. So lots of different options in this space, but just it's understanding your kind of wagon wheel and then applying the best possible option within that.
Yeah, cool. Lots of options there.
Yeah, sorry, too many there.
Okay, so if somebody is then listens to this and thinks, oh, actually, that'd be a really good idea, that would really get me out of a hole, that would really help or push the book business forward, what would you say would be the top tips for those people before they look at getting the finance? What do they need to have in place or do?
Yeah, so I think to be kind of finance ready, I would say is one, you kind of know what sum of money you need, because it's important to understand what that money is going to be used for. Understand what is the consistent monthly incomings into your business. What can you afford to allow out the business in terms of any kind of payments to do with investment. From there, you're kind of ready to start looking at the options because you understand those drivers. I need this sum of money. This is why I need it. I know the ins and the outs of my business. Okay, that's when you come across to the likes of yourself, Cheryl, where you can start to help them understand the different products. And then similarly, ourselves at Swoop, we could start to say, okay, you know you need this money and you know these are the ins and the outs. Okay, so let's go through all the possible options and find what is the one that's going to work for your business, because what we need to do is what's motivating here is speed. Do you need cash as quickly as possible? Is price, do you need this to be as cheap as possible, or is cash flow the most important thing? So what I mean by that is it might be slightly more expensive, but we've spread it over a 5-year period as opposed to a 12-month period.
Yeah.
And then the next thing to have in mind, if you want an expedient process of going through quickly, is I have that knowledge, but in order to get a quick cash in bank, there's a couple of documents that are going to be needed along the way. Bank statements is number one. Having your bank statements ready to go either in 3, 6, 9, or 12. Most important document, particularly for anyone looking for kind of £200,000 and below. Bank statements is the most important document. If it's above £200,000, have your P&L, balance sheet, and age debtors readily to hand, because that's often what a lender will be using. They'll be using those kind of management accounts and bank statements to do the quantitative analysis. The bits that they'll often ask for, particularly again, I would say maybe again £200,000 and above, and it's probably where you come in, Cheryl, is the forecast piece. Being able to show, I take this sum of money in, what impact does it make to my business, and being able to articulate, usually over a 12 to 36 month period, what that impact is. That's super important, because as we look above, say, that £200,000, that qualitative element becomes more and more important, because they need to really buy into your business, how you're going to work, and also how this money is going to implement this kind of future growth that you're going to have in place.
Yeah, perfect. That all sounds brilliant, and I think it's really important to have those documents and those expectations initially, because then it's not such a, oh God, I've got to go and find and do all of this.
Yes,
so having already, it just makes it a lot smoother, doesn't it?
Yeah, I think the biggest reason why something gets slowed down is because documents aren't there.
Yeah, that's cool. Well, I just wanted to finish up with one last thing. So we've been talking obviously finance, which in turn means debt for a company or an individual. And traditionally, debt is not seen always as a good thing. So obviously funding is a tool and it helps us in our business. So how can we reframe it to debt isn't always bad?
Yeah, I mean, it like you have come to this realization of wanting to do something differently. Like you want to grow your business, you want to hire someone, you want to move into a new category, you want to build a website. It's an enabler. It's an enabler, but it always starts with the business owners and their aspiration. I mean, it could be an enabler to keep the lights on, because you know you're landing this contract in 2 months' time, which is going to change your life exponentially in your business life. But in order to do that, I need the cash to keep the lights on. But it's an enabler. So it's understanding, again, going back to what we were saying earlier on, is like, what is your aspirations? Like, what do you want to grow? Do you want to survive? And from listening to that and understanding that aspiration, and then understanding the in and the out and the future in, future out of the business, can we use this as an option. It won't always 100% be the option, and that's why it's really important that the likes of ourselves can give a quick no just as much as being helped you get the cash, because what we don't want to do is send people down a journey where it isn't the right fit. But it can change the game completely, because business owners has to mean they're inspirational, they're entrepreneurial, and to realize those dreams and ambitions, you need these growth levers, and cash kind of comes in as a growth lever a lot of the time, and that's kind of why we exist, is to try and make sense of it, and then hopefully put that right option in place when it is eligible for you.
Yeah, no, that's cool. And obviously, just to caveat this, we're not telling everyone to go out and get funding for the sake of it. It is a place of funding is a tool to help you. As you said, it's a lever. It's a way to help you get where you want to be. So it's
and I think it's always had that stigma of, like, even the word debt has a stigma of, like, pressure and things like that. Like, and I think in a weird way, COVID has really opened up business owners' ideas to financing, because bounce back loans and C-bills got so widely distributed to so many businesses. Now, a lot of the time, the bounce back loan was just used to keep the lights on and go through that period, because they were locked out from being able to do what they did. But it opened their eyes to be like, oh, I can get this capital, put it to use to do something for me to improve my scenario. And it's kind of broken down that stigma more to be like, it's okay to get this, but it does go back to, like, understanding the need to it. But it definitely has a bit of a stigma to it. But I do think actually those bounce back loans and C-bills, because they were so widely distributed, has really opened up business owners' eyes to it as a form of finance.
You know, definitely, it's definitely opened up a lot of our clients' eyes to it as well. And I always try and look at it as, when I'm having one of those moments myself, I always try and look at it as, when we're buying a house as people, we have to have the debt to buy the mortgage to buy the house, but that debt's okay because you're buying your house. So it's the same. All right, I know it's a completely different scenario, but it's the same sort of principle, isn't it?
It's the same principle. I think it's a really nice analogy, but as you're rightly alluding to, Cheryl, it's so normalized in terms of, like, no one is in the fortuitous position just to be able to walk up to whoever estate agency is, here, I'll just transfer you this outrageous sum of money. But it's attainable then, because you've got that to be able to go and get the house that you want for you and your family. But it's the same as the business owner. Like, you've got aspirations to get somewhere, so sometimes you need that lever to get you there. And in the same way, you work it through from a mortgage perspective, is like, I will only get the mortgage that I can use to get the house that I can afford. And it's the same thing as the business owner. You got to use the right products that work for my business model, so that I can use it in the right way to get to me where I need to go.
Yeah. Oh, brilliant. Oh, thank you so much for going through all of that. It's really helpful, and I'm sure it's going to really make it more understandable for a lot of our clients as well, and people watching this video. So if anyone is interested and wants to chat further, then please do get in touch with us at Pink Pig, and we will obviously do the introduction to the relevant person over at Swoop who looks after that relevant product that's needed for them. So yeah, thank you very much for joining us, Ciaran.
Thanks so much for having me, Cheryl.